Ladies and gentlemen, I want to talk to you about the Treasury auction marketplace. And I want to represent to you today 30 questions on NASDAQ on the government side concerning the primary market and the underwriting process for Treasury securities at the auction marketplace, and the characteristics and the features of Treasury securities and agency securities. In a very short period of time, I'm going to blast you with 30 regulations. So if I were you, I'd stay very focused. The largest securities market in the world is the Treasury auction market. The size of a marketplace is represented by the dollar par value of an offering. And it's not uncommon to know, I think we all know, hundreds of billions of dollars of Treasury bills, notes, and bonds. Hundreds of billions of dollars are auctioned off on the auction floor on behalf of the Treasury with the Federal Reserve. Are you with me so far?
Yes.
And so we're dealing with a tremendous marketplace. And there is a form that I asked you to take a look at called an official bid form. It's a Treasury bid form. Large securities firms like the Goldman Sachs of the world submit what are known as tender offers. Now a tender, listen to me carefully, is an offer to bid. To tender is to bid or an offer to buy. These large firms submit tender offers right down to the auction floor where the treasuries are auctioned off to go public at the IPO level. We're at the IPO level right now for Treasury securities. And the bids that are submitted down there by all of these firms, these large firms, are called 7 competitive tenders. A competitive tender is a competitive bid or an offer to buy. And they're called competitive tenders because these bids are in competition against one another. These firms are bidding against one another, looking to bid and win the entire block of $300 billion or $500 billion worth of Treasury notes, bills, or bonds that are being auctioned off. Are you with me so far?
Yes.
Now, your client, Mr. Johnson, or your institutional client, would like to buy IPO Treasury bills, notes, or bonds. You go to the same location for him, right down to the auction floor to buy IPO, concerning his position of $100,000 worth of IPO bills, notes, or bonds. But the bid that you submit on behalf of your client is called a non-competitive tender, Series 7, because your client is not looking to submit a bid for the entire inventory. A client bid is a non-competitive tender. Are you with me so far?
Yes.
And therefore, you're going to the same location to buy IPO for him. It's just that your client is guaranteed to be filled with security. Are you with me so far?
Yes.
The questions that we have to be aware of now are, what are the features and the characteristics that make up the tender offer? What's in that tender bid? Are you with me so far?
Yes.
So let's take a look at third paragraph down where it says competitive versus non-competitive tenders. Large security firms submit offers to buy treasuries. These bids, these competitive tenders, are submitted right to the Federal Reserve Board. Are you with me so far?
Yes.
They are called 7 competitive tenders. The competitive tender, this is the key, will specify the price and or the yield at which Goldman Sachs, the member firm, is willing to buy the block of Treasury bills, notes, or bonds that are being auctioned off. So in the competitive tender, it will specify the price and or the yield that the large security firm is willing to purchase the block of bills, notes, or bonds. Are you with me so far?
Yes.
This is IPO auction process. Your client, through you, will submit 7, a non-competitive tender, right down to the same location to the auction floor. Non-competitive bids on behalf of your client is guaranteed to be filled with security, but Series 7, last sentence there, your client must agree to accept the yield and the price that was determined by the auction market. And so what am I telling you? I'm telling you that the price that your client pays for his bills, notes, or bonds, and the yield that he'll earn on his bills, notes, or bonds is the price and the yield that was determined by the auction bid process. Are you with me so far?
Yes.
Now, I want you to know that the federal government is for everyone. Your client does not need you, the financial advisor, to buy Treasury securities because the federal government is for everyone. He can go directly to the auction and buy Treasury bills, notes, or bonds directly himself. Are you with me so far?
Yes.
Bypassing you. But if he goes direct, the price that he pays now and the yield that he'll earn now is a little bit different than the price and the yield that he earned and he paid when he went through you that was determined from the auction market. Are you with me so far?
Yes.
Let's take a look at what the client pays now when he goes direct. Are you with me so far?
Yes.
Right above that box, paragraph above that box at the bottom. Your client can buy securities directly at the auction by entering a non-competitive tender. Always non-competitive. Are you with me so far?
Yes.
Your client will pay Series 7 the lowest price of all accepted competitive tenders. So the cost basis there is a little bit different. What was the cost basis before when he went through you? He paid the price and or the yield that was determined by the auction market. Now, when he goes direct, he's paying the lowest price of all accepted competitive tenders. Are you with me so far?
Yes.
And the yield will not be determined that the client will earn until all the competitive tenders are accepted. So the price and the yield is a little bit different when he goes through directly to the auction market and submitting his direct non-competitive bid. Are you with me so far?
Yes.
All purchases of Treasury securities that go through the auction market directly all pay the same price. Are you with me so far?
Yes.
That's a one-sided auction market when you all pay the same price. And the name for a one-sided auction market is called Series 7, a Dutch auction. What is a Dutch auction? It is an auction process whereby you're all paying the same price. I can think of, as Crash knows, an equity IPO that went public where clients went directly to the issuer to pay the same price to receive and buy IPO stock. What was that stock IPO that was brought to market by means of an underwriting through a Dutch auction IPO underwriting?
Microsoft.
Google. Just thought you should know. Are you with me?
Yes.
You know, the good news for you is that you don't have to worry about when bills, notes, or bonds are auctioned off weekly, monthly. Are you with me so far?
Yes.
That would be, I think, a little unfair, so that's not on NASDAQ, and thank God for that. So we have the regulations associated with the IPO underwriting process, associated with the competitive versus non-competitive tender, and that's the auction process. Are you with me so far?
Yes.
And now I want to start moving into some of the regulations associated with the characteristics and the features of Treasury securities. Are you with me so far?
Yes.
The issuer is the U.S. government. Lucas.
I had that question on that.
You had what question, Lucas?
When they're auctioned.
Okay. On the 7?
On the 7th.
Well, I'm in shock.
I had it too.
Really? How many questions did you have? One?
Just that one.
Okay, good. We can still get a 95 on the exam. Let's not worry about it. I want to talk to you about Treasury securities. Now, you know, moving from the municipal side into the U.S. government, the issuer is the U.S. government. Are you with me so far?
Yes.
These are the highest caliber securities that we have. They carry zero credit risk. The nominal yields, of course, are not fabulous. Are you with me so far?
Yes.
Not in this interest rate marketplace. But I can tell you that there is no potential default of debt service. Are you with me so far?
Yes.
Now, face is $10,000 per security, also known as par value, only payable at the security maturity. Are you with me so far?
Yes.
We begin with the characteristics of the Treasury bill. This is the most unique of all of the Treasuries. Its features are unique. Unlike any other Treasury, the bill is the only one of the Treasury securities that's 7 issued and purchased at a deep discount from face value. It's a discounted security. You're going to go out there and buy a position, buy a bill for $9,000. Are you with me so far?
Yes.
Now look at the maturities of the bill. All these characteristics I'm giving you are on NASDAQ. Maturity of the bill are 1 month, 3 months, and 6 months. Now, I want to show you a 1-month bill. Look up. You're going out and buying this security at a deep discount from par value or face value for $9,000. At the end of the 1-month maturity, you get repaid face. Are you with me?
Yes.
Face is $10,000. How much did the bill holder earn now in what you've always known to be discount principal appreciation?
$1,000.
Right. You've earned $1,000. Am I right? At maturity. Am I right?
Yes.
What have we always known this $1,000 to be?
Capital gain.
No, it's not a capital gain. It's not a sale of a capital asset. You held the security for the 1-month maturity. Are you with me so far?
Yes.
Can't be a capital gain. Listen up. Don't get too excited. I want you to stay focused here, Mike. This $1,000 has always been known as the discount principal appreciation that you've earned at maturity up to par. Am I right?
Yes.
But the security, the bill, trades Series 7 flat for a security to trade flat is to be non-interest bearing. That means the bill does not have a coupon rate built into the bill. That means that the bill is a non-interest bearing security. That means the bill does not pay interest income. Are you with me so far?
Yes.
So take a look at what's going to happen. The IRS is going to look into this investment and determine where the bill holder is making his money. He's making his money right here in this $1,000 as a result of buying the bill at a discount and getting repaid face value at maturity. Am I right?
Yes.
This $1,000, although technically truly is discount principal appreciation, will not be treated for tax purposes by the IRS as discount principal appreciation because they want to tax you. Are you with me so far?
Yes.
And how are they going to tax that $1,000? They're going to treat it as investment income even though it's not investment income, just so they can tax it to the investor. 7 at OI. Are you with me?
Yes.
Now, if a security is issued and purchased at a deep discount from face, are you with me so far?
Yes.
Then it has to be priced on what is known as, look up, a discount yield to maturity basis. That's a discounted YTM. Now what does that mean? Well, what do you know about the YTM? That's the client's overall percentage return that the client earns at maturity. Am I right?
Yes.
That's not just any YTM. It's a discounted YTM. That means that built into this discounted YTM, which is the client's overall percentage return at the maturity of the bill, reflects the $1,000 that he earned as a result of buying it at $9,000 and getting repaid face value at maturity. If you attempt, MSRB has established 2 forms of bond pricing for all bonds. Are you with me so far?
Yes.
You can price bonds in terms of dollar pricing. Are you with me so far?
Yes.
In which case those bonds are known as dollar bonds. And how do we verbalize and price bonds in terms of dollar pricing? We price it as a percentage of face. 90 means 90% of $1,000, which means $900. That's dollar pricing. Pricing the bond, taking its quote, and transferring that quote to become a percentage of par value is dollar pricing. Am I right?
Yes.
The other form of bond pricing MSRB has established in its bylaws is on a YTM basis, on a yield to maturity basis. Am I right?
Yes.
Discounted securities are not priced in dollars. They're priced on a discount yield to maturity basis. Why? If you attempted to price a discounted security like the bill in terms of dollar pricing, then the dollar pricing of the bill would not reflect the $1,000 you're earning as a result of buying it at a discount and getting repaid face value at maturity. By pricing the discounted security on a discount yield to maturity basis, built into that discounted YTM is the $1,000 that you're earning as a result of buying it at $9,000 getting repaid face value at maturity. And so, take a look at the characteristics of the bill more acutely. It's issued and purchased at a deep discount from face. It is priced on a discount YTM basis to reflect the appreciation earned. The $1,000 that you're earning at maturity is taxed like investment income is taxed at OI. The security trades flat, it's non-interest bearing, and the maturity of the bill is 1 month, 3 months, 6 months, 7. A lot of characteristics on that security. Are you with me so far?
Yes.
Like the bill is unique to the other treasuries, notes and bonds, treasury notes and treasury bonds are very similar in that they trade with a coupon rate built into the note of the bond. They are interest-bearing securities. They have a nominal yield. They pay interest income to the note holder and to the bondholder. Are you with me so far?
Yes.
They are priced in dollars as a percentage of face of $10,000 per note or per bond in Series 732s. When we talk about govies are priced, treasuries are priced in 32% of $10,000 per note or per bond. We're not talking about bills. Bills are not priced in dollars and 32s. Bills are priced on a discount yield to maturity basis. Notes and bonds are priced in dollars. And the financial benchmark that the market uses to price those notes and those bonds in terms of dollars is in 32% of $10,000 per note or per bond. Are you with me so far?
Yes.
So there's only one difference between the note and the bond, and that is in the security's maturity. Just like muni notes versus muni bonds are short-term debt instruments, are you with me so far?
Yes.
And municipal bonds are long-term debt instruments. Same here. Notes, maturity 2 to 10 years. Bonds, 10 years or greater. 7. Are you with me?
Yes.
Stay with me.
Yes.
And so, the 3 primary treasury securities are and always have been Treasury bills, Treasury notes, and Treasury bonds. But I want to tell you something about the federal government. Please listen to me and look at me. Federal government wanted to become more competitive for our investment capital in dollars. Are you with me so far?
Yes.
There's only one way to do that. create another product that never originally existed. Are you with me so far?
Yes.
So I want to show you a product that never originally existed before. There are blocks of Treasury bonds. Did I say bills? Did I say notes? I said Treasury bonds. That as it gets ready to go for auction, are you with me so far?
Yes.
Could have a designation attached to this particular block to be stripped. Now, what that means is this. When $500 billion worth of IPO Treasury bonds get ready to go public, and they go public through the competitive and non-competitive bid process that we just established, once this block of $500 billion worth of par value worth of T-bonds hits the marketplace, the secondary market after it goes public, the coupon would be stripped away from the T-bond. The stripping of a block of Treasury bonds represents the stripping away of the coupon from the T-bond. You know the coupon is inclusive into the T-bond, am I right?
Yes.
The stripping of the coupon away from the T-bond has allowed the federal government to become more competitive, because what they've done now is, once the block of T-bonds hits the secondary market and their coupons have been stripped away from their T-bonds, with me so far,
yes,
they've created two investment vehicles from the original T-bond. You can buy the coupon, which is sold separately and traded in the marketplace separately, versus the T-bond. Are you with me so far?
Yes.
They've created two investments. Are you with me so far?
Yes.
Now, when you strip the coupon from the T-bond to create two separate securities, are you with me so far?
Yes.
That are traded separately, we create a security that's called a Treasury strip. What was a T-strip? It was a T-bond whose coupon was stripped away from it. When you look at the Treasury strip now, the strip created by having its coupon stripped away from its T-bond once it hits the secondary market. How does the Treasury strip in the secondary market now trade? 7 flat. Why? Because its interest, which was its coupon, was stripped away from it to be traded and sold separately to create two products from the original Treasury bond. Are you with me so far?
Yes.
How many securities have I now given you that trade flat? 2. T-bills, T-strips. The proper trading terminology for the Treasury strip is called the Treasury receipt. Are you with me so far?
Yes.
That's what you're going to see on NASDAQ. Treasury receipt means Treasury strip. Are you with me?
Yes.
Now, hang on. Donegan has a question.
For T-bills, can't the maturity sometimes go to 1 year?
No. It's issued in cycles. It's 1 month, 3 month, and 6 month. Okay? Watch this. There is another security. Are you with me so far?
Yes.
That trades flat. That's on NASDAQ. It's called, correct, a zero coupon bond. 7. Zero coupon, word coupon means interest. This is a corporate bond that never had a coupon built into the bond underwriting. Are you with me so far? It opened up at the IPO flat. Zero coupon bond is a corporate bond that never had a coupon rate built into the corporate bond. Are you with me so far?
Yes.
How many securities have you now given you the trade flat? 3. Strips, bills, zero coupon bonds. Are you with me so far?
Yes.
Now look, bills, notes, bonds, strips. We look at the characteristics and the features of these securities. Are you with me so far?
Yes.
And neither any one of them are indexed for inflation. And so what do you think the federal government said now? We're going to have to create a new Treasury security that's indexed for inflation. Are you with me so far?
Yes.
Hence the creation of what is called the TIP. Treasury Inflation Protected Securities. These are Treasury securities, whether they are Treasury notes or Treasury bonds, listen to me carefully, that are inflation indexed. Are you with me so far?
Yes.
They are built to provide more money during inflationary periods of time. Are you with me so far?
Yes.
Let's take a look at how a TIP security works. Please look at me. I want you to look right here. I got a client that goes out and buys a $1,000 TIP note. Instead of a Treasury bond, it's a Treasury note, and it's inflation indexed. Are you with me so far?
Yes.
This Treasury note is indexed for inflation. That means it's going to provide you with a return that moves with a parallel movement of inflation. Are you with me so far?
Yes.
At the time that this client was long this TIP note, the CPI rose 100 basis points. What does that mean to you? 1% rise in the cost of inflation, right, which is the consumer price index. A 100 basis point movement in the market represents a 1% movement, which represents a $10 increase in the price of goods and services that reflect the rise of inflation. This TIP note has a 4% coupon rate built into the note. Are you with me?
Yes.
at maturity of the note, are you with me so far?
Yes.
Look at what the note pays. $40 in interest, represented by the 4% coupon rate. Stop, time out. I thought we said that this security was inflation indexed. Well, the coupon is still paying $40. Are you with me so far?
Yes.
You cannot change the interest rate that's built into a security. It is fixed. Are you with me so far?
Yes.
Well, clearly that $40 will be eroded by the CPI's rise of 100 basis points, am I right?
Yes.
So then how does the tip really work? Well, look at what happens to the principal repayment. Instead of getting repaid $1,000 for the note, you get repaid $1,010. You see that additional $10 above the note's face value? Are you with me so far?
Yes.
That is in direct correlation with the $10 price increase that's represented by the increase of the CPI, 100 basis points. And so therefore, how does the tip work? Where does the tip provide you with a hedge with inflation during inflationary periods of time? Not in its interest income, not in the coupon rate, in its principal repayment. The principal Series 7 will be adjusted and pay you more money above the face value of the note or the tip bond that's in direct correlation with the performance of the CPI. Are you with me so far?
Yes.
Interest is fixed. Principal is adjusted for inflation, Series 7. And so, we look at the characteristics and the features, and they continue to build. These regulations just keep coming on. Are you with me so far?
Yes.
As a matter of fact, they don't stop. At least you should feel that way. Are you with me so far?
Yes.
Please. But I got to tell you something about our federal government. What an amazing infrastructure. They said the economy, listen to me carefully, certain sectors of the economy need liquidity. And we need to help that level of liquidity out in the marketplace by creating agencies. These agencies, the federal government said, should be created to issue securities. And the proceeds of securities sold will then provide liquidity to maybe institutions like savings and loan institutions or commercial banks, or maybe the liquidity generated from the sale of securities by these agencies might go to provide income to and liquidity to other agencies of the federal government. Are you with me so far?
Yes.
But the problem here is that the federal government does not own these agencies. I mean, they are not agencies of the federal government. If I say this language to you, federally sponsored agencies, are you with me so far?
Yes.
This word is significant. See that word sponsored?
Yes.
This is not an agency of the federal government. The word sponsored agency means this. This was an agency that the federal government was all for in its formation. It said to the industry should form these agencies. We're all behind their sponsorship and their creation. Are you with me so far?
Yes.
To provide liquidity to certain sectors of the economy, whether it's agricultural financing, or to lend money for student loan financing, or to lend money for the mortgage side of the industry and mortgage-backed agencies. Are you with me so far?
Yes.
But these are not agencies of the federal government. To be sponsored in their formation and creation by the federal government means that the federal government supports their creation, but they're not federal agencies. It is only when I say federal agency, and I omit that word sponsor, is that an agency of the federal government. Are you with me so far?
Yes.
Therefore, the securities that these federally sponsored agencies issue are not direct obligations of the federal government. They don't carry a AAA rating. And if these agencies go out of business, I want to assure you the federal government does not have the obligation to step in to repay you. Are you with me so far?
Yes.
Because they are not agencies of the federal government. There's only one agency up here of the federal government whose securities are AAA rated, and that's Ginnie Mae, the Government National Mortgage Association. All others are sponsored agencies. Are you with me?
Yes.
Now, going to the sector that says agencies, what do we have to know for NASDAQ and coming down the home stretch? A tremendous amount of regulation. I'm going to tell you exactly what the 7 seeks right now. Look at me. You got to know the name of the federally sponsored agency or federal agency here. You have to know the specific denominations of the securities that they're selling and issuing. Are you with me so far?
Yes.
You then have to know where that liquidity is going to. Is that money from the securities sold by these agencies going to a sector of the economy? Is it going to lend to institutions? Or is it going to be benefited by other separate sponsored agencies? And you furthermore must know that if a client buys any of those securities that's issued by those sponsored agencies or agencies, how is the interest taxed to the investor? A whole battery of features. And so I'm going to give them to you right now if you're ready. Are you ready?
Yes. Yes.
First federally sponsored agency is called the FFCB, Federal Farm Credit Bank. This sponsored agency was created to provide liquidity to the agricultural sector. Are you with me so far?
Yes.
I'm talking about the farm owners of America who need money for agricultural financing. And here's how we provide liquidity to that sector. The FFCB, this federally sponsored agency, will issue 7 short-term discounted notes and interest-bearing bonds that have both short and long maturities. When the FFCB sells those short-term discounted notes and interest-bearing bonds, that liquidity, that money that's raised from those securities that are sold, is going to be benefited by 3 other separate federally sponsored agencies who are going to receive the benefit of the liquidity of the money raised by the FFCB. Question now becomes, who are those 3 other separate federally sponsored agencies that are going to receive the benefit of the liquidity by the money raised by the securities that are sold by the FFCB? They are Series 7. The Bank for Cooperatives, the Banks for Cooperatives, Series 7 Bullet 1, the Intermediate Credit Banks, and the Federal Land Banks. Now the question becomes, why are those 3 other separate federally sponsored agencies receiving the benefit of the liquidity of the money that's raised by the securities sold by the FFCB? Because those 3 other separate federally sponsored agencies provide agricultural financing to the agricultural sector of America. That's why. Are you with me?
Yes.
Are you with me?
Yes.
If a client buys these securities, short-term discounted notes and interest-bearing bonds, the tax treatment on its interest is 7. Federally taxed, exempt state and local. 7. There's your first federally sponsored agency. Next page. Your next federally sponsored agency is the Federal Home Loan Bank. The Federal Home Loan Bank, are you with me?
Yes.
The Federal Home Loan Bank provides liquidity, Series 7, to the savings and loan institutions of America. So the S&Ls right here now are going to receive the liquidity and the benefit from the money raised by the FHLB. Question now becomes, where's the FHLB getting the money from to be able to provide liquidity to the savings and loan institutions of America? And the answer comes from their capacity to be able to borrow and buy up to $4 billion from the Treasury. Are you with me so far?
Yes.
Their borrowing capability. If a client buys an FFCB security, are you with me so far? The interest is subject to federal tax, exempt from state and local tax to the investor. 7. Your next federally sponsored agency is Sallie Mae, the Student Loan Marketing Association. So what happens is that the child, our children, they go down to the banker and they say, listen, mom and dad don't have money to provide me with an education. Give me a student loan. The banker gives our children money for the loan. Are you with me so far?
Yes.
At a very low cost of leverage. And the question now comes, where is the banking institutions getting the money from to be able to lend that money to our children for the education and the educational cost of the children of America? From Sallie Mae. The Student Loan Marketing Association is a federally sponsored agency that provides liquidity to have that money lent by the commercial banking system in the form of student loan financing. Question now becomes, where is Sallie Mae raising the money from? Are you with me so far?
Yes.
From the securities that they sell of common stock that's listed on the New York Stock Exchange and the American Stock Exchange. 7. Are you with me so far?
Yes.
Well, that handles, look up, the agricultural sector. That handles, of course, the savings and loan sector. That handles educational costs for student loan financing. But now, what about the mortgage industry? And Jesus, what can I say? Fannie Mae, Freddie Mac, on the verge of going out of business, and they bailed them out and saved them for toxic securities buybacks. Are you with me so far?
Yes.
We got to talk about the mortgage side of the market. And so we talk about your first federally sponsored agency, provide liquidity to the mortgage industry, and that is the Federal Home Loan Mortgage Corporation Series 7, nicknamed Freddie Mac. Freddie Mac provides liquidity, Series 7 Bullet 1, to the federally insured savings institutions. Federally insured savings institutions who need money and extra financing for new housing during tight credit markets like the marketplace we're in right now. Are you with me so far?
Yes.
Freddie Mac provides that liquidity by buying residential mortgages from the savings institutions. The savings institutions sell those residential mortgages out there in the secondary market to Freddie Mac, and through the sale, Freddie Mac then provides liquidity to the savings institutions. Are you with me so far?
Yes.
Freddie Mac raises money, second paragraph, for its operations by issuing mortgage-backed bonds, pass-through certificates, and guaranteed mortgage-backed certificates. Freddie Mac issues notes, stocks, and bonds, as you see, that are traded on the New York Stock Exchange. Your next federally sponsored agency that provides liquidity for mortgage financing to the mortgage side of the marketplace is Series 7 Fannie Mae, the Federal National Mortgage Association. They raise money and buy insured FHA and VA residential and conventional mortgages from the commercial banking system. The commercial banking system, again, sells those mortgages out there into the secondary market to Fannie Mae, and through that sale, it is providing liquidity to the commercial banking system, whereas Fannie Mae getting the money from to be able to buy those mortgages at a discount from the commercial banking system for money they raise from securities that are issued and traded on the New York Stock Exchange in the form of notes, stocks, and bonds. If the client buys a Fannie Mae security, the securities are subject Series 7 to a tri-tax liability. 7, federal, state, and local tax. First tax change. Are you with me so far?
Yes.
And finally, we talk about the federal government and the federal agency called the Government National Mortgage Association, and the security that they issue and sell is called a Ginnie Mae certificate. Are you with me so far?
Yes.
There's that word again, certificate. Where did we see that earlier? A real estate investment trust certificate. The word certificate means security. Now, I'm going to draw you a picture of a Ginnie Mae certificate. Are you with me so far?
Yes.
So I can explain this particular product to you. And let's take a look at this. The Ginnie Mae certificate has a trading name on Wall Street. It's called the Modified Pass-Through Certificate. We just call them pass-throughs. Are you with me so far?
Yes.
Now let's take a look at this certificate. This is a picture of a Ginnie Mae certificate, and I'm going to design for you right now an underlying portfolio of residential homeowner mortgages. When the client buys a Ginnie Mae certificate, what is he technically investing in? He's technically investing in an underlying portfolio of residential homeowner mortgages, which represents the portfolio built into and underlying the certificate. He's playing the residential homeowner mortgage market. Are you with me so far?
Yes.
Now let's design a portfolio underlying the certificate. I give you the following portfolio. Built into this portfolio, are you with me so far?
Yes.
Underlying it are 30 residential homeowner mortgages. 30 homeowners and their mortgages. Are you with me so far?
Yes.
Each one of those mortgages represents the following term: 30-year, fixed, at a cost of 6.25% yield. Are you with me so far?
Yes.
Now that's the cost of borrowing that those homeowners are paying. 30 homeowners have 30-year fixed mortgages at a 6.25% interest rate. Are you with me so far?
Yes.
Here's why the security is called the Modified Pass-Through Certificate. When these homeowners on the 15th of the month pay their mortgages, are you with me so far?
Yes.
These 30 homeowner mortgage payments, are you with me so far, are then modified to be able to be directly passed through right back to the certificate holder to pay you a 6.25% yield on your investment. Are you with me so far?
Yes.
Their cost of borrowing represents your yield. Are you with me so far?
Yes.
That's why it's called a pass-through certificate. The results of this portfolio flow down to the Ginnie Mae certificate holder. Are you with me so far?
Yes.
Now what's exciting about this particular product is the following. The income that you're receiving is for how long?
30 years.
30 years. We consider that Series 7 Bullet 1 lifetime income. Series 7 Bullet 1. The income you're receiving for 30 years, you're going to receive, look at me, Bullet 2, monthly. This is paying you monthly income. So when do you think that we recommend the Ginnie Mae certificate? To people and investors who are approached retirement, right? Might want to bury that into the IRA. They might need to live on this monthly income. Are you with me so far?
Yes.
Now, what should happen, look up, if some of these homeowners default on their mortgages or even foreclose? Well, who's issuing the product? This is a federal agency. So who do you think is going to step in and repay you? The federal government. The security, Series 7 Bullet 3, is AAA rated because it's issued by a federal government agent, a federal agency. Are you with me so far?
Yes.
It pays monthly income for the portfolio of the line of the life of the mortgages. The only way you don't get income for 30 years on a monthly basis if there's any refinancings that cut into the term of the line of the credit. Are you with me so far?
Yes.
It's an exciting product. Let's take a look now right here at the 4 or 5 questions you'll see on Ginnie Mae's. On Ginnie Mae's. It's a mortgage-backed security called the pass-through certificate. Again, it's AAA rated, issued directly by the federal government. It pays monthly income. Are you with me so far?
Yes.
And the income that you're going to receive is based upon the maturity of those mortgages for, in this particular case, 30 years, and there's no potential default. So it's an exciting product. Are you with me so far?
Yes.
And that monthly income is significant. And to the back area that we saw now, I isolated for you earlier, we talked a little bit about collateralized mortgage obligations. And I want to talk to you about these CMO investments because they're very popular in industry. Collateralized mortgage obligations, Series 7, Bullet 1, are mortgage-backed securities. Another mortgage-backed security. Are you with me so far?
Yes.
And the mortgage-backed security, known as the CMO, or the collateralized mortgage obligation, would take the principal and interest coming from a portfolio of mortgages that's built into and underlying the CMO investment to create various tranches. The word trench, 7, means bond. What's a CMO? It's a bond. Built into a portfolio of mortgages that's built into this mortgage-backed security. Those mortgages will generate principal and interest payments. Those principal and interest payments coming from a portfolio of mortgages that's underlying and built into the CMO investment itself are creating various tranches or bonds that the client can choose, where each bond or each tranche, are you with me so far? Has a certain maturity structure, interest rate that the client can earn, and risk exposure that can best suit the client's suitability investment objective needs. Now, what's so popular about collateralized mortgage obligations is Series 7 Bullet 1, this is a AAA rated product. Are you with me so far?
Yes.
It's secured by, fourth paragraph down, CMOs are secured by Fannie Mae, Ginnie Mae, and the Federal Home Loan Mortgage Corporation. The minimum denomination of CMO investments is $1,000. The high quality of the collateral qualifies its rating, are you with me so far,
yes,
of this mortgage-backed security. And the interest payments are paid monthly, Series 7, and taxable at a tri-tax level. 7! I want you to know something. You have just graduated this program. You should give yourself a round of applause. I'm proud of you. That's what you call a real Series 7 training program, and that's what you call a program that is designed to knock out the 7. Now, what I want to do is I want everybody in the program here to take a break. I want you to go outside. Just give me about 5 or 7 minutes. I'm going to come out and get you so that we can go into phase 2. I got a surprise for you. I'll see you in 5 minutes. I'll come out and get you. Don't leave.
Where's my cap and gown?
I want you to clear the room. Thank you. Stay.